A building owner called me recently because he was buying his very first commercial building in downtown Frederick. His first question was, is commercial building insurance basically the same as homeowners insurance? And the answer is no. And if you make that assumption before you buy a building, it can cost you a lot of money, thousands of dollars. There are a handful of things that determine whether your building is easy to insure, difficult to insure, or dramatically more expensive than you expected. In this video, I'll show you how to know if you're buying a building that's going to be difficult to insure, why the purchase price has almost nothing to do with your insurance limit, and how to avoid the expensive mistakes I see first-time commercial building buyers make all the time. But before we get into all of that, let me tell you about a phone call I got recently. The the business owner called me because he was buying his very first commercial building in downtown Frederick. And on the surface, it seemed like a pretty straightforward purchase. There was one detail that changed everything. The building sits inside Frederick's historic district. His first question was, is commercial building insurance basically the same thing as homeowners insurance? And that's where we started. Because while both build policies insure buildings, that's kind of about where the similarities end. Commercial property insurance is underwritten completely differently, and understanding those differences before you buy the building can save you from some very expensive surprises later. So let's answer his question first. Is commercial building insurance basically the same thing as homeowners insurance? Not really. At a very high level, they both insure a physical structure. If a fire damages your home, homeowners insurance helps pay to rebuild it. If a fire damages your commercial building, commercial property insurance is designed to do the same thing. But that's really about where the similarities end. A homeowner's policy is built around the idea that an individual or a family lives there. The insurance company is looking at a completely different type of risk. With a commercial building, the first question becomes, what kind of business is operating inside? Think about it. Two different buildings that look almost identical from the outside. One is an accounting office and the other is a woodworking shop. Same square footage, same roof, same walls, but one has sawdust, heavy machinery, finishing chemicals, and a much greater chance of a fire. From an insurance company's perspective, those are two totally, completely different risks. That's why commercial property insurance isn't just about the building itself. It's about what happens inside the building, how it's being used, and how likely that use is to result in a claim. And once you understand that, it starts to make a lot more sense why insurance companies ask so many questions before they ever offer you a quote. Because they're not just trying to figure out what your building is worth. They're trying to figure out how risky it is. So if they aren't primarily looking at what you paid for the building, what are they looking for? They're trying to answer one question. How likely is this building to have a claim? And if it does, how expensive is that claim going to be? To answer that, they're going to look at a handful of things. The first is the year the building was built. Generally speaking, older buildings have more unknowns. They may have older wiring, plumbing, roofing systems, or structural components that haven't been updated in decades. Next is the construction type. Is it wood frame, brick, masonry, steel, or concrete? Different construction materials perform very differently during a fire, a windstorm, or other catastrophe. So that has a direct impact on how the building is underwritten. Then they'll see what business occupies the building. An office building, a retail store, a restaurant, and a machine shop may all be the same size, but they present completely different levels of risk. A restaurant with open flames and commercial cooking equipment is simply a different insurance exposure than a CPA's office. They're also going to ask when the major building systems were last updated. Has the electrical been replaced? What about the plumbing, the HVAC, the roof? These updates tell the insurance company whether they're looking at a building that's been well maintained or one that's more likely to experience a costly loss. Finally, they'll consider things like how close the building is to a fire hydrant in the local fire department. If firefighters can get water on a fire quickly, there's a much better chance they will limit the damage. If the building is an area with limited fire protection, the potential loss becomes much larger. Every one of those factors helps paint a picture of the risk. And here's where my client's building became really interesting. It wasn't just an older building, it was an older building in Frederick's historic district. And that changes the insurance conversation in a pretty significant way. Now, here's something that surprises almost every first time commercial building buyer. The price you pay for the building has very little to do with how much insurance you should buy. Think about it this way. Let's say you buy a building for $600,000. That doesn't automatically mean you need $600,000 worth of property insurance. Why? Because the insurance company isn't trying to buy your building from you. They're trying to answer a different question. If this building burns to the ground tomorrow, what would it cost to rebuild it? And those two numbers can be very different. Maybe you got a great deal because the seller wanted out quickly, and maybe the value of the land makes up a big portion of the purchase price. Or maybe it's an older building that would actually cost significantly more to rebuild today because labor and material costs have gone through the roof. Insurance is focused on the cost to reconstruct the building, not what you paid for it. That's why getting the value right is so important. If you insure the building for substantially less than what it would actually cost to rebuild, some policies can reduce what they pay on a claim, even if it's only a partial loss. This is called coinsurance. And so that is an expensive lesson you don't want to learn after a fire. This is another reason why working with someone who understands commercial property insurance is so important. Determining the proper insurance values isn't guesswork. It's one of the most important parts of putting the policy together. Now, remember that historic building I mentioned in downtown Frederick. This is where things get even more interesting because once a historic district gets involved, rebuilding isn't always as simple as replacing what was there before. So this is exactly what my client was running into. His building wasn't just old, it was located in the historic district. Now, that doesn't mean you can't insure it. It just means there are a few more things to think about it. Let's say the building suffers a major fire. If it's a newer commercial building, rebuilding is usually pretty straightforward. You rebuild it using today's materials and today's construction methods. But with a historic building, you may not have that option. The Historic Society may require certain exterior materials, architectural details, or construction methods so the building continues to match the character of the surrounding area. Those requirements can make rebuilding slower, more specialized, and much more expensive. There's another wrinkle, too. Even while you're trying to preserve the building's historic appearance, today's building codes may require you to upgrade things like the electrical system, accessibility, fire protection, or other life safety features during the reconstruction. So now you're balancing historic requirements with modern building codes. That's why with older buildings, the insurance question isn't simply, can I rebuild? It's, can I afford to rebuild it the right way? And can my business survive while that process is happening? Those are questions you want answered before you own the building, not after you've had a loss. Which brings me to the final piece of the puzzle. Once you understand the building, understand the risks, and understand what it will actually take to rebuild it, the next step isn't calling 10 different insurance companies. It's putting together the right story for the insurance company that actually wants your business. Once I explained all that to him, the conversation changed. He stopped asking who's the cheapest insurance company, and he started asking the right question. How do I make sure the insurance company understands what they're looking at? Because that's really what this process is all about. Once you've gathered all of the information about the building and its age, construction type, occupancy, updates, replacement costs, and any historic district requirements, the next step is putting together a complete submission for the insurance companies. Think of it this way. The underwriter has probably never seen your building. They've never met you. Everything they know about your property comes from the information your broker puts in front of them. A well-prepared submission helps the underwriter understand the building, understand the improvements that have been made, and understand why your account deserves serious consideration. From there, your broker's job is to get that submission in front of the right insurance companies and create real competition between the underwriters that actually want to insure a building like yours. That's very different from simply sending your information to every insurance company you can find and hoping one comes back with a good price. The goal isn't to get the most quotes. The goal is to get the right underwriters competing for your business. And if you're thinking about buying a commercial building, don't wait until a week before closing to think about insurance. Have the conversation early. The earlier you understand how the building is going to be underwritten, what it's actually going to cost to insure, and whether there are any issues that could complicate rebuilding after a loss, the better decisions you'll make before you ever sign on the dotted line. If you understand how your building is going to be insured before you buy it, you're already ahead of most business owners. But buying the right insurance is only half the battle. The next challenge is making sure your policy renews the right way every single year because I can tell you from experience, most businesses don't overpay because the insurance market is bad. They overpay because the renewal process starts way too late. I made another video that walks through the 90-day renewal strategy, why the 60-day submission rule matters, and what your broker should be doing long before your policy expires. Click right here, and I'll show you exactly how to stop last-minute insurance renewals from costing your business money.